केसरी त्योहार.
Well, the other side of the story, oil, and who better than M.K. Surana, former CMD at HPCL, and Kirit Parikh, former member at the Planning Commission and oil and gas expert, joining in on the show to talk about exactly that. Sirs, both of you, thank you so much for your time today. Mr. Surana, if I could start off the discussion with you, the OMC under recovery, do you think this is going to be, turn out to be a big concern as, sort of flagged off by the Petroleum Minister himself yesterday?
Yeah, good morning to you. Yeah, that's correct. The under recovery of the OMC is a big concern, and day by day it is becoming a bigger concern. And that is on the back of the fact that probably the market is still not fully factoring in the problem which we have on the crude market. It may be probably because there is a lesser demand from China currently by around 2 million barrels last in April. Or maybe because the surplus inventories and the floating inventory on the sea and the release from the SPRs have taken care to some extent. But if you are having around 10 million barrels a day outage from the market and going on for around 75 days and not yet any solution in the mind, and the oil marketing company is not able to recover even the cost of the crude, it is a big concern, and the distress will increase day by day.
Parikh, although the government has been very vocal in saying that, it's a fallacy or misconception that oil prices are going to be increased anytime soon, but do you think there is no option and we will see, retail fuel prices go up?
See, the distress on the oil marketing companies have to be taken care of. There is no doubt about it. Now, whether we do it by passing on some of the price hike to the consumers or we do by finding some other mechanism to compensate. Now, a part of the excise duty was reduced some time back. Now, what are the other options with the government? That is to be seen. But there is no denial that price hike is one of the options, and at some point of time, it will be inevitable.
What is your own analysis on how much can the government actually hold on to passing on to the fuel price hike onto retail?
It should have been done earlier.
Mr. Parikh, my question is to you. Mr. Surana, I'll just come back to you. I just want to get Mr. Parikh as well in. Yes, Mr. Parikh.
Shall I answer this?
Yes, please.
Hello, I think the government may say that this was nothing to do with elections. One could sort of trust them in some sense and say that, okay, they were expecting that the Iran war will hold in a month or two and that the oil market would come back to normal. And therefore, they didn't want to raise the prices. But now it seems this war is going to go on for some months. And then the losses that the oil marketing companies are facing are significant. And therefore, I think the government has no choice but to raise prices, in my opinion. And if you can ask people to reduce consumption, but the only effective way to make them reduce consumption is to raise prices. And surely all the public vehicles which are being used, all the government use of transport will go down. But how long will that remain low consumption is a question is a questionable thing. Because what happens generally is that people get used to things and then high price and so on or something like that, and then begin to go back to their own old methods and so on. And therefore, I think it is unavoidable that the prices have to rise.
Mr. Parikh, by how much? Really, that's the golden question, right?
Yeah, I'm sure it won't go back to the same level as before. This will be increased gradually, not at one go, because I think government wants to minimize the impact on inflation and other things. So my feeling is that will go up by maybe 5% at a time and so on. But it has to increase. The cost of this has gone up by nearly 60-70%. So you cannot really increase the price by 60% all at once. But you can go gradually and say, okay, I will increase by 2 rupees, 3 rupees per month and so on. And you can go ahead like that.
Rana, your take with regard to the quantum of the increase, what's your sense? I'm sure that while the government has one eye on the losses that are being generated, 1,000 crore a day is the understanding, but the other eye is also on inflation and the macro impact.
Yeah. You see, prices have gone up. Our rupee has depreciated significantly.
Yes.
So impact on inflation is going to be there, whether you like it or not. The only way we can really significantly reduce this impact is by cutting down our consumption of oil. Now, saying that is very easy to cut down the consumption of oil. But how would you do this? You have to recognize what are the options which are really available. If you say that, look, I want to cut down the consumption of petrol, you ask people to, pool the cars and then go and use public transport. Now, people would use public transport, I think, as long as it is cheaper and doesn't take much more time than what private transport is. If it takes me 1 hour to go by public transport to my office, and by car it takes me 10 minutes or 15 minutes, then, how long would I keep using public transport is a big question. And I really do think indeed that this is public transport has to be, really you must invest in it and make it such that it is almost equal and competitive in terms of time and cost with other modes of transport. Then people will certainly do. I mean, in New York, for example, if you see New York City, everybody uses public transport because it's available and you don't have to do much effort, but it takes me just the same time as I have going by taxi and so on. And so on. So I think unless you make public transport that much attractive, people won't go to public transport. So that's one way. Now consider diesel.
Let me take Mr. Surana's view on this as well. Mr. Surana, give us a sense. Of course, as I did mention, government will have one eye on the macros as well when they're trying to rejig the price of retail fuel. What's your sense? What's the percentage hike likely to be, given that they have to balance both of those?
See, while at one end we can say it is difficult to increase it at a time, but at the same time, if we do not increase it substantially, then every day passing the under recovery pool will increase. And therefore, in my opinion, initially a bigger hike will be required, may not be 100%, and then maybe gradually increase in partial amounts. But the second part is that consumption part is a right call from the Prime Minister, because there are two types of consumption. One is a discretionary and one is essential. So while going to office, people will have hurry, they may not. But let's say the people go to drop the children to the school, it is nearby the bus, but still they take the car because that is the way it is. Or just you're going to buy the vegetables from the market and still you take the car. So there are discretionary things also. Probably at least it will give an alarm bell in the mind of the people to contend that. And the second part is like the gold, silver. The last year, the increase in the gold import was almost 25%. The silver import was more than 100%. So this call on the consumption is aimed at from a short-term measure as well as a long-term measure, and at least give an alarm bell ringing in the mind of the people, at least to think. As far as the fuel is concerned, I think it has to work on all the front, the consumption, the use, the efficiencies, the repurposing of the molecules. All things has to be attacked together to ensure that we get the most optimum output from each molecule of crude which we are importing.
Mr. Surana, the government is pegging 30,000 crores losses on a monthly basis for OMCs. At the same time, you saw yesterday the royalty rates for upstream companies were reduced. Do you see this losses of 30,000 crores will now be borne by the upstream companies as well going forward?
See, I think the reduction in the royalty rate may be a longer term item which would have been under work. And so we should not be confusing with the immediate measure with the long term measures. But in the past, the upstream companies have shared a part of the burden. Now we have to agree that it cannot happen that one part of the sector earns the profit and other part of the sector assumes losses. Now the government has to work on it, especially considering that MS and HSD were basically decontrol items. But on the LPG, which is a control item, definitely compensation, there is a mechanism to do that. I think there are some more ways, innovative ways how to be thought of to ensure that the OMC remain in the green of the health.
Right, okay. Mr. Parekh, Mr. Surana, both of you, thank you so much for your time today and giving us that insight.
Thank you so much.
Okay, let's take a very quick break on that note. Slightly stable for the market, so it seems that massive correction which played out the last 2 days, that definitely has stalled. And now to the gains. We'll take a very quick break, be right back with more.
The real truth.
Welcome back. You're watching First Trade, and let's go and look at what's happening in the FNO market with FNO 360 powered by 5 Paisa. The market is holding off to 23,400 levels after some put writing which is coming in at the highest strike level. The market. The Nifty absolutely flat at this point in time at 23,400, and the open interest you can see 1.91 crore. That's the kind of open interest which is there in there, and it's flat as we speak. The Nifty Bank again, it's also flat, slightly tilt towards negative there, but you have a premium of 200 and open interest, and there's some unwind also happening in Nifty Bank as we speak. That look at the constituents of Nifty Bank, you will see stocks like HDFC Bank where we are seeing some long build up happening. We have seen Kotak is seeing long build up today, Axis is seeing some long build up, while there's a short build up happening in ICICI Bank, SBI, Federal and AU Small Finance Bank there. What's happening with call and put writers? Interesting trends coming in there. 23,300 has a good put writing coming in at this point in time, and while there's a call writing which is happening at 23,400, so that's there. But if you look at the distribution chart, 23,400 is something which is a work in progress for the market there, because it's trying to push itself above the 23,400 mark, but there's a strong support at 23,300 at this level. So it's a range bound market as we speak. Futures gainers include stocks like Dixon Tech, short covering happening 5.6% up, Zinc, Hindustan Zinc up 4%, and Asian Paints up 4%. Now SAIL is also seeing some short covering with the stock up nearly 4% as we speak. In futures losers, you have stocks like Kalyan Jewellers, where we are seeing some pressure. The stock is down 5%. Tata Power is down 4% after the earnings, and iShare is down nearly 2.6%. All seeing some short build-up coming in. Open interest gainers include stocks like Vedanta, where there's a long build-up happening. KE Industries and Kalyan Jewels are seeing some short build-up happening, and open interest up between 4 and 5% there. In open interest losers, you have stocks which are active today, which is DRL after the earnings. There's a short covering happening. Open interest down. Blue Star is seeing some short covering, and Indian Hotels is seeing some kind of bit of activity with open interest down nearly 1.23% there. Most active in today's Dixon is 10,500 May call. The stock hovering above the 10,655 level. up 536. This 8,000 contracts which have got added, but it's most active. The premium is jumped 171 to 502. In the put sex, you have the Titan 4000 May put, where the stock hovering just about the 4,000 mark with 2 lakh contracts added in open interest. So overall the market is trying to hold off at the 23,400 level with some aggressive put writing which is coming in at that level. Aisha.
Okay. Well, I was just looking at some of those active movers. Look at a Hindustan Zinc. Look at what's happening in Vedanta. Let's try and understand the other side of this hike in import duty on precious metals. And let's try and understand what does it bring on the table for domestic miners like Hindustan Zinc, which could actually win big as consumers look inward. Ashesha is here with that insight. Ashesha?
Well, yeah, so the government has come out with a notification and they've gone ahead and hiked import duty on gold and silver. We did talk about the repercussions on jewelry stocks, but one segment of the market which is expected to benefit as a result of this is the metal sector, and some players like Hindustan Zinc, which generate nearly 20 to 30% of their revenue from silver operations. And now that import duty on silver has been announced, players like Hindustan Zinc, which actually mine silver in the domestic market, are likely to benefit as a result of this. They will earn higher realizations, and second, they will also have an edge versus other import-dependent companies. One, they can go ahead and announce price hike in line with what imported price of silver looks like. So that is one advantage that players like Hindustan Zinc are likely to benefit as a result of import duty that has now been announced. That is likely to result into higher realizations. And second, of course, if the prices are kept lower, then volumes could inch higher. So two-way benefit that players like Hindustan Zinc, in fact, not just Hindustan Zinc, even Vedanta mines silver. So that is also likely to gain as a result of this. But on the flip side, all those companies and sectors which consume silver as their raw material could be negatively impacted. One, on account of higher prices, and two, if at all they buy from these companies, then they will have to buy at elevated prices because of the surge in prices that will now happen in the domestic market. So some industries like electronics and electricals industry, we have electric vehicles, automobiles, semiconductors, all of these consume silver as their raw material, and that is one basket of the market which will be negatively impacted on account of surge in silver prices in the domestic market.
Thanks, Ashesha, for that. We have now Rakesh Arora joining us today. Rakesh Arora, founder Go India Advisors. Rakesh, how do you see some of the metal companies getting impacted by this current move?
So, as commodity prices have been going up for pretty much, some time now. And that has largely been driven by the AI development that we have seen. So there are some estimates out by research, firms. We say that in the next 18 years, we'll have to mine as much copper as we would have mined in the last 10,000 years. So that's the kind of impact that we are seeing. Copper demand will grow by 50% in the next 15 years or so. Because of this AI impact. So this is a phenomenon which is, playing out, and there's been underinvestment into, mining industry. So till the time, mining industry does catch up, we are into a little bit of a higher for longer kind of scenario. Since copper is in short supply, there is substitution happening into aluminium, which again is going up. But the dynamics are very different. Because aluminum gets into an oversupply getting into end of this year. So one needs to be a little bit more cautious. Precious metals have a different play altogether. They are a play on the real interest rates globally. And since, inflation is moving up, whereas, central banks have been slow in increasing the interest rate, people are falling back on precious metal to, safeguard against inflation. So this is kind of the broad mechanics on the commodity side.
Rakesh, hi, morning. I want to get the Hindustan Zinc angle, like my colleague was just highlighting. The fact that now with this import duty jump, Hindustan Zinc is looking like the obvious winner, right? But is this already in the stock price, given its move that we've seen in the last 1 year? Or is there real earnings upside that the market has still not priced in after this import duty hike?
So clearly, this 5% increase in import duty adds directly to their, bottom line, because in India, the civil prices are going to go up. And so to that extent, Hindustan Zinc benefits. But having said that, commodity prices are trading way beyond what is fundamentally kind of can be justified. So, like in case of silver, I think the fair price is around 55 to $60, and it's currently at around 80, 85. Similarly, for copper, the fair price is around 11,000 to $11,500. Aluminum is more like 26, $2,700. So commodity prices are trading at way higher level than what we can justify fundamentally. And so to that extent, investors have to be cautious, not to be caught at the upper end of this rally.
Interesting. So I think this is turning out more a silver versus gold kind of debate, Rakesh, given that Hindustan Zinc is India's largest silver producer and silver was already, on a tear. Does today's duty hike make silver the bigger earnings story for Hindustan Zinc than zinc itself?
Yeah, I mean, obviously, higher silver prices help, but still bulk of the earnings come from zinc, and zinc prices have also been, reasonably strong. So, while there's a silver lining, but zinc continues to be the main driver.
Stands to be the winner here, other than Hindustan Zinc, Rakesh?
So we don't have any other, producer of. Yeah. So apart from Hindustan Zinc, there's hardly anything. Obviously, Vedanta as a holding company for Hindustan Zinc, there's a play there too. But the main driver is Hindustan Zinc only.
Rakesh, how do you look at copper prices? It's hovering around $6.6. Do you expect that to inch up? Because you spoke about the fact that the kind of mining that we will have to do going forward. Do you think the prices will also be inching up from the long-term averages?
So see, there is a lot of speculative element also in precious metals and base metals. So normally they tend to go well beyond the fundamentally justified price, and which is what we are seeing right now. Now, the question is whether the AI thing is a bubble, whether the companies will moderate their capex program, whether there'll be enough returns on AI. So those are the questions which are going to drive the demand supply for copper in coming years. So these are some of the questions to whom we are looking for answers. It's not very clear at the moment, but given the current trend, there would be persistent shortages of copper for at least the next 2-3 years.
Yeah, interesting. Rakesh, so good chatting with you today and getting in that quick insight on what exactly does this import duty hike really imply for, of course, silver, gold and the allied companies as well. Good chatting with you.
Thank you.
Let's take a very quick break, or in fact wind it down on this edition of First Trades in the Market. It's a goodbye from Sajid and me.
Weight. And if you keep...
Morning, you're watching Midcap Masala on ET Now. I am Snehi Shah. With me as always on the show is my colleague Shrishti Sharma. And this is a show where we are going to take you through the deeper end of the market, the broader end, and tell you what's happening in the mid-cap and small-cap space. Very good recovery coming in over there, about 1% jump on both of those indexes, while the Nifty continues to see about gains of about 0.3%. But given the kind of cuts that we've seen in the previous two trading sessions, this speck of green also looking good for the markets. But let's start interacting with all the corporates that we have lined up, and we have a bunch of corporate conversations lined up on the show. So let's start by talking about earnings candidate V-Guard. Very strong set of numbers coming in from the company in the quarter gone by. So let's understand what led to this show and how sustainable is this going ahead. We have Mr. Ramchandran Venkatraman, the director and COO of V-Guard, joining us on the show. Mr.
Mr. Venkatraman, hi morning and thanks for your time. And you know, quarter four has been so much meaningfully ahead of expectations of the street. And this kind of growth we've seen for you across segments in quarter four. Help us understand what were the key demand drivers behind the strong recovery in the second half. After you did mention that the first half was rather soft. So what has led to this robust recovery in second half?
The first half, the summer had failed last year, and naturally, the impact was felt on first half of last year. That also, impacted quarter three in some way, but not as aggressively as in the first half, right? But towards end of Q3, most of the challenges were cleaned out, and so we were able to, post a broad-based recovery in Q4. And fundamentally, all categories participated in it, although relatively, that did continue to be a moderate drag on some of the summer categories, particularly air cooler or fan, which was moderately, lower compared to the other categories. But that being said, I think overall growth across the portfolio was good.
All right, good to hear about it. Mr. Venkatraman, morning. This is Shrishti also joining in. But help us understand what kind of a summer demand are you seeing on ground? And on the back of that, how is Q1 of FY27 shaping up so far?
So, okay, at an aggregate level, South is, responding well. I think, broadly, summer is playing out, and we are able to see the impact of that on summer categories in South. That being said, there is an element of uncertainty and unpredictability which keeps continuing because we keep having intermittent showers, which have been happening, right through April, and even this month, this is happening. So I think, but overall demand recovery has been strong in South because, summer broadly has held up. When we come to non-South, I think non-South, even right through into April has been challenging, with, particularly East and North, yet to see, impact of, a strong summer. So West has been moderate though. And this is what has been happening. And I think, our performance is reflecting the underlying impact of what is happening in the underlying impact of weather. We do believe, thankfully for our categories, with the summer playing out and summer, actually starting somewhere around middle of April in North. So we have some time, month of May, June, and even parts of July. So we remain optimistic about a good summer performance in non-South for now. Yeah.
Okay, and Mr. Ramchandran, before we talk about segments, talk to us about the spike seen in induction cooktops given the recent LPG shortage situation. How has the demand for induction cooktops fared after that initial spike that we've seen? Is it still sustainable or was that a one-time panic buying led type of spike that we've seen?
No, I think, in induction, I think companies responded to the lift in induction demand, but I think they were constrained by the inventory of finished goods, raw material, as also the retail inventory which was present, right? So I think the strong lift that we saw in March and portion of April, accounted for cleaning up inventory, with manufacturers and in trade. Subsequent orders, have been coming up, but mostly, companies have to, organize their, supply chain and, supply to meet the demand. We do believe that, for sure, for another 3-4 months, I think strong demand will hold up, mainly as there is latent demand in the market. And, the filling up of inventory across the supply chain will also happen. In the midterm, we believe that growth in induction will continue, and I think the consumers will be stocking up induction as a backup, if not for primary use. So one thing that has happened with this, expected shortage or anticipated shortage, which of course has not fully materialized, and because supply of gas is continuing, although occasionally there are challenges in places, which is leading to a longer waiting period. So people have realized the importance of induction, and the people are again going back and stocking, and therefore we do believe that induction demand will the trajectory of demand will change for the midterm and long term compared to what we have witnessed over the last 5-6 years.
All right, but along with that, the West Asia crisis is impacting the commodity inflation and some of your component supplies. Which product categories are currently seeing the highest pressure on the cost or availability? And on the back of that, what is the pricing action you have already undertaken or plan to undertake?
Broadly, the impact of the crisis can be understood on two dimensions: supply and the commodity inflation. Coming to the commodity inflation, broadly we are witnessing between 8 to 13% increase across our product portfolio, with maybe one or two categories which may be an outlier going up to about 15%. Mostly companies have commenced, given the significant increase in input cost, all companies have activated interventions in market over late second half of March and early April. And broadly about 70% of the input cost increase has already been transmitted. And I expect the remaining 30% to get transmitted over the next 15 to 30 days. So that's where we stand. And we, of course, have to wait and watch how this is going to impact, the overall demand scenario. But presently, I think, across summer categories, for us, our portfolio is predominantly summer category driven. The response here is more to, the weather and less to underlying consumer demand drivers. Coming to the supply side is holding out, and mainly, the impact is reflected in terms of significant increase in input costs. And in the early part of this period, people have suppliers have increased prices even on existing purchase orders, pre-existing purchase orders. So that has fundamentally been the background. I think organized players are a bit better off compared to the unorganized sector.
Okay. Mr. Venkatraman, I remember when we spoke earlier, you were confident of closing the year with double-digit exports growth. Now that the war overhang is still at play at large, how have exports materialized?
I think for us, exports are limited. Mainly, our exports are focused around SAARC and Africa, and they form a very small part of our overall revenue. So it's not material or significant to V-Guard's performance.
All right, and lastly, the Sunflame integration is now almost complete. What synergies or margin benefits should we expect from the business over the next few quarters?
So Sunflame integration is, complete in parts, and some parts are still underway. Basically, the supply side, sourcing, those areas, the integration is underway. Should be done in another month or two. Integration is progressing well. I think we have completed, and we are starting to see benefits of integration fundamentally in areas like customer service, quality, and warehousing and logistics, where, in all of these areas, we are seeing significant efficiencies, and also we are now able to match the performance and SLA that, V-Guard is, used to deliver. On the sales integration, I think sales integration commenced somewhere around November of last year, and I'm happy to say that this is complete. We are seeing early shoots, and in terms of favorable impact of sales integration. But we believe the impact will come with a lag of 3 to 6 months. So in the next 6 months, we look forward to seeing the benefits of sales integration, which will fundamentally come on 2 dimensions. One is that, the Sunflame portfolio would be able to travel across V-Guard trade partners. I think that is number one, and therefore will deliver a wider reach for Sunflame. The other area, where Sunflame would strongly benefit is in deployment of a sellout capability of V-Guard, which action is, still underway and probably should be complete in another quarter.
Okay, really appreciate that. Thank you so much for your time today, Mr. Venkatraman, and once again, congratulations on the strong quarter you've seen. So viewers, that was the management of V-Guard who had joined us on a very good set of numbers. Let's shift focus, and in fact, let's keep it going with the consumer durable space. We now have the management of Stovecraft, Mr. Rajendra Gandhi, who's the MD of the company, joining us on the show. Mr. Gandhi, hi, morning. And we were interacting with V-Guard before this interaction, and they were speaking to us about Induction Cooktops and the kind of demand that is seeing sustaining. Let's start with just that. Induction Cooktops for you also in Q4 have delivered very good volume as well as value growth. Help us understand if you too are still seeing the demand of induction cooktops playing out even now, because I understand it was because of that LPG shortage. But as things are stabilizing, is demand still sustaining, or was it a one-off that we had seen when it came to induction cooktops?
Yeah, good morning. Everybody today generally want to talk about the induction cooktops. Yes, it is a in thing at the moment. We are seeing the cooktop getting into adaptation as a primary cooking appliance from the normally Indian households, which are fully dependent on LPG gas. I believe that the current scenario is, of course, a huge jump from where it was on the induction cooktop. But this is demand continues to be there. There has been some supply side constraints because of the sudden spurt in the demand. We are well equipped of the manufacturing companies that are in this space, and we foresee this demand to be very strong for the year ahead also.
All right, but let's talk some numbers then. And you had earlier guided for margins to remain above 11%, but margins continue to be flat around 9.5%. By when can we expect the margins to reach to 11% level, and what factors could play well for you?
We are in line with our plans for addressing that 11%. In fact, we are moving ahead from there. This current quarter is impacted by one of those one-time events like a huge forex loss. There was huge volatility, the rupee was continuously depreciating, and we had to account for that. And that's why the costs were highly, going up because of all this. But I think we are well ahead of in control of that and moving ahead from there. So we are confident of moving ahead from the 11% also.
That sounds good, Mr. Gandhi. Let's talk about small appliances. They now contribute to roughly 40% of the revenue, while cookware and cookers have also seen strong momentum. What's the growth outlook here, and how is the demand shaped up for all of these segments so far in Q1 of FY27?
For the quarter gone by and the current period, we see very strong demand for both cooking appliances and for pressure cookers. The demand continues to be very strong. We are continuously growing. So we are seeing a good traction also in the market for all the category of products that we are in.
All right, but along with that, now your segment Pigeon expanded into 16 new cities in Q4. What has been the response in Tier 2 and Tier 3 markets? And are these markets behaving differently from metros?
Yeah, both. It's a brand both for the metros and the Tier 2 cities. And we are seeing good traction, growth in our retail also. Even revenue per store is also going up. Margins is improving. And as you are already aware, we are spreading across the country. Already we are closer to the 330 number. We are on track to grow at about 25 stores every quarter. Both in the Tier 1 cities where we are already there with our stores, in the Tier 2, both are seeing similar kind of acceptability.
So on that note, Mr. Gandhi, you are on track to achieve this 500 exclusive Pigeon stores by FY27 as you had guided earlier?
Yeah, that's the plan. We are around that number, we should be there. We will be able to grow at 25 stores every quarter.
Okay, and also talk to us about the impact on commodities, your raw materials. We understand the West Asia crisis is impacting commodity inflation. Which product or categories are currently seeing the highest pressure on costs, on availability, supply? And on the back of that, what is the pricing action that you have already undertaken or you plan to undertake?
Yeah, we have adjusted our prices for this quarter, beginning this quarter. And almost all commodities, aluminum, copper, stainless steel, and all the electronics that go into the manufacture of our appliances, all are impacted both because of rise in commodity cost and also the depreciation of the rupee. Overall, there is an impact. We have been able to pass on this cost impact beginning of this quarter.
So, can you quantify that price hike for us, Mr. Gandhi? How much has the inflation been? How much have you passed on?
Approximately across the category, we are at about 10%, and that is the overall cost increase, which is just passed on to the consumer.
Okay.
All right. But along with that, let's talk some of the other numbers. And you had earlier guided for 15% growth and doubling revenue over 4 to 5 years. Which channels or category will drive it the most?
Both offline and online channels are doing well now. Either two, the online channels were growing very fast, but the cumulative impact of our general trade, modern trade, and our own stores, we see both demand surging. Good demand from both these channels. We are now very confident of the growth numbers that we have committed, and also with the additional growth in this induction category, it is adding to our confidence.
Okay, so that sounds good. Apologies, I'm coming back to the pricing issue. Now that you've passed on 10% and we still have the war overhang continuing, any further price hikes on the cards? Is that something you're planning?
For the moment, for this quarter, we are in control of both the price that can address our margin expectation. But if there is again any deterioration in our cost, that is again, if there's going to impact, then there's no choice for us, and we'll have to address this again. But for this quarter, I think we are covered.
All right, with this, we let you go. So good having you on the channel today. Thank you so much for your time. Great speaking. And yes, of course, the business has been doing great. So all the very best for the future.
Thank you.
Thank you so much. So that was Mr. Gandhi of Stovecraft talking to us about what transpired well and what is the outlook going ahead. But from one company, let's focus to Sagility India. The company did come out with its numbers, and talking about Sagility, the company did come out with an inline set when the consolidated revenue has seen a jump of close to 3%, but the margins have seen a bit of a decline, while in terms of the EBITDA and the profitability as well, we have seen a bit of a contraction. But what's the outlook going ahead? Let's understand all of that with Mr. Ramesh Gopalan, who is the Group CEO and MD of Sagility India, joining us. Hi, very good morning and welcome to ET Now. Firstly, help us understand that what were the factors behind the margin dilution and the contraction that we have seen in your numbers? Was it because of the higher employee cost, investments in AI, or some of the one-off that you would like to elaborate?
Thank you. Good morning, and thank you for having me on your show. Yes. I mean, if you look at the margins Q on Q, first of all, our business has seasonality, right? So Q3 and Q4 are our seasonal quarters. And so the margins do tend to behave differently in these quarters compared to the other quarters. So if you look at Q4 compared to Q3, yes, there was a margin dip, and that's basically due to a couple of one-off items. One, we had a one-time employee what we call bonus, but it's actually because our increment cycle has moved from a calendar fiscal to a April through March fiscal. So we did have a one-time catch-up because the increments are only going to be effective April 1st onwards. So that was a one-time. And secondly, we had to shut down a couple of delivery centers, and there were some write-offs, one-off write-offs that we had to take as part of those closure, right? So those were the one-off items. But also we are continuing to invest in tech and AI, but that's something that will continue in the future quarters as well.
Okay. And Mr. Gopalan, what is the expected trajectory for EBIT margins in FY27? Any number you can help us with?
Yeah, we generally guide on EBITDA margins. So we've done a 25.3% for fiscal 26, and we are guiding to a 24 to 25% adjusted EBITDA margins for FY27.
All right. So we look forward to that. But let's talk about the attrition rate. That has jumped to 38.1% from 22.8% in Q3. What drove this sharp increase?
Again, you got to understand our business, right? Like I said, we have seasonality in our business. And so the volume surge happens in Q3 and Q4. And once the seasonality ends, we generally have a reduction in headcount. So if you look at historically our Q3 and Q4 numbers, the attrition generally is higher in Q4 because a lot of the temporary staff that we hire for the seasonal work generally they're not there at the end of Q4. So that's why you see that attrition. Better number to look at is between FY26, 25 and 26. There is a slight increase in attrition even in those numbers. That's because our seasonal revenues have increased compared to the last year. So it traditionally used to be 3% of our annual revenues used to be the seasonal revenues, but that's increased to roughly 5.5% to 6% in FY26.
Okay. And Mr. Gopalan, let's talk about artificial intelligence. You have deployed about 37 AI use cases through Smart Tech and Synchrony. Can you help us understand, or can you quantify the benefits that you've seen from AI so far in terms of your cost, productivity, anything on that front?
So two things, right? So one, use of AI for client delivery. So that's where, like I've said, our clients are going through enormous cost pressures. And so they want partners like us to help deliver business outcomes while reducing the total cost of ownership. So that's where we deploy technology, we use AI. And that improves the productivity, that eliminates some of the transactions. And that's essentially a lot of them gets passed back to the clients as benefits. And we also have started using AI in our internal operations, in our hiring, in our training, and so on. And that is likely to reduce our operational expenses in the future. But that's just being implemented as we speak. And so we expect to see the benefits of that flowing in the second half of this year and more in FY28.
All right, but what percentage of your current operations is already AI enabled, and what is the target over the next 12 to 18 months?
So it's a journey, right? So it's very difficult to say that somebody's operation is fully AI enabled. So for most of our clients, we run multiple processes. So we are enabling many of them with AI-based use cases. And like I said, it's a journey. So we've started deploying some of them in FY25. That has increased in FY26. And we expect to keep increasing that in FY27 and 28.
Okay. And lastly, Mr. Gopalan, before we let you go, what's your current deal pipeline and win rate? How are contracts looking right now? And how should we be looking at this number for the new financial year?
We've guided to a low double-digit growth for FY27. That's because we're very confident of how the pipeline looks. The only uncertain thing is the timing of closure of some of those deals in the pipeline. So basis that we could revise our forecast during the year. But currently our pipeline looks very healthy. Like I said, the deal constructs are changing. We are looking at more transformational deals where we commit to business outcomes while helping clients reduce the total cost of ownership. And some of those deals typically take longer to close. But otherwise, very healthy pipeline. And we continue we closed 17 new logos in FY26. And we expect to close again a double digit in FY27 as well.
All right, good to hear about it. But with this, Mr. Gopalan, we'd like to thank you for taking the time out and speaking with us this morning.
Thank you very much.
All right, but with this, viewers, we are completely timed out in this edition of Midcap Masala. It's a goodbye from me and Snehi and the entire team who put the show together. Thank you so much for tuning in.